Welcome to another episode of Financially Free with MoneyMD. Thank you for joining. Be sure to subscribe so you don't miss out, or visit our website, yourmoneymd.com. Sign up for our newsletter so you can get updates. Follow us on Instagram at money_MD. Facebook. We're on a lot of those social media platforms, bringing you updates, information that may or may not apply to you or someone that you know. So feel free to spread the word. If it's something that you enjoy, comment, email, send any questions or any topics that you might like me to cover. But today I'm going to be talking about income-based repayment plans. What is an income-based repayment plan? Basically, an income-based repayment plan is a plan that was implemented and created in order to make student loan payments more affordable. You know, we have pretty much a student loan epidemic right now. We're somewhere in the trillions with the amount of money that's owed from student loans, and it can become pretty expensive. They generally put you back on a standard repayment plan of 10 years, which is what the standard is. So depending on what your balance is, you know, if you're in the hundreds of thousands of dollars, like most of my clients are, then that monthly payment can look like a mortgage payment. It can get pretty expensive. So the income-based repayment plan was actually implemented in 2009 to make the payments more affordable. What they did was lower your payment, but, you know, there's really nothing in life that's free. When you're given something, usually something else is coming on the back end. You know, everybody's excited about it because it makes it more affordable. In most cases, you know, it can. Let's take for instance a $200,000 student loan at a 7% repayment interest rate. So under a standard plan, that $200,000 student loan would be $2,322 a month to pay that off. You'd pay it off for 120 months, and at the end of the time, you'd be paying $278,660 total back for that loan. Now, $2,322, depending on what your income is, that may not even be feasible. You know, provided you have other stuff going on, you have a life, you like to go out to eat, you have a car, you have rent or a mortgage. So you can see why maybe they needed to come up with another program to make it more affordable and easier for people to make these payments. So with that same example, $200,000 student loan at a 7% interest rate, with the income-based repayment plan, it would take the $2,322 a month payment that we would normally be paying, and it would take us to $895 a month. That sounds a lot better than $2,322, right? Well, let's get down to the basics really, and we'll come back to that and talk a little bit more about what that looks like. So, the income-based repayment plan is available to those with federal student loans. So federal student loan borrowers, I don't know, you may or may not know that there are different loans out there. There's federal loans, direct loans, personal loans, parent plus loans. So as long as you have a federal student loan, direct or FFEL, federal family education loan, then you're eligible to participate in the income-based repayment plan. So if you have a loan that's not federal, like a private loan or a parent plus loan, you're not eligible for this program. If you have a loan that's in default, you're also not eligible. So that's important. You know, we've talked about before why it's important to keep your payments current. So the way that, like I said, it was implemented in 2009, and Obama made some changes in 2010 that he hoped would enhance and improve the plan that was already in place. So the changes that he put in place had to do with your discretionary income. So what they do in order to qualify for this program, they look at your, you have to qualify. It's a process. You have to fill out some paperwork, W-2s, pay stubs. They want to know how much money you have, what are your bills, what's left over at the end of the month, also known as your discretionary income. So they look at your discretionary income and they do some calculations, and typically take about 10% of your discretionary income to cover your student loan payment. So, all right, they make it more affordable, 10% of your discretionary income. One of the perks and the benefits that everybody's waiting on, that I hear clients tell me all the time is, I just have to make my payments for 20 years, which was a change that Obama made to the income-based repayment plan. Make your payments for 20 years consecutively, not miss, stay current, and then at the end of 20 years, whatever your balance is will be discharged, wiped off. You don't owe anything else. So, in some cases, what they found was the income-based repayment plans may not cover the restructuring of the payment that they give you may not cover the interest portion of your loan. So, obviously in our example earlier with $200,000 for a student loan at 7%, $895 a month under the income-based repayment plan doesn't cover the principal and interest amount of that loan. It's just not mathematically possible. So the government said, all right, we'll step in and we'll cover the interest for you for the first 3 years, and after that, any interest that's not covered, we're going to add it to the total amount that you owe. So let's look at it. If you should be paying, in our example, $2,322, and they reduce your payment to less than half at $895 a month, what does that do? Well, it extends the life of the loan, or it extends the balance of the loan. So you're going to keep accruing interest. It's going to keep going up because like we just saw in most cases, your monthly payment is not even enough to cover it. People choose, sometimes they give you choices of where you want to be, of a range. They say, okay, you have 3 payments you can choose. Which one would you like? Which one's more affordable? Which one do you feel more comfortable with? Most people choose the lowest amount. Obviously, you don't want to give all your check to Sally Mae or Navient or whoever Sally's friends are this week. So they want to choose the lowest amount. Well, what that does is it increases the length of the loan typically, and you end up paying more over time. So it's really important to understand and to look into these programs and know how they'll affect you. People who are waiting for that discharge after 20 years, there's a difference between discharge and forgiveness. And there's a forgiveness for loans for public service individuals. Those who work in public service, they can actually, under the income-based repayment plan, have their balance forgiven after 10 years of consecutive payments. Forgiven, you don't owe anything else, and that's public service, teachers, if you work in the government, or if you work for a non-profit organization, then you may qualify for that forgiveness. But for us regular folk, most of my clients who are in the healthcare field, all of my clients are in the healthcare field, doctors, depending on, now we're not talking about, special circumstances where you get into repayment plans and they cover some of your student loan balance or debt, which some of them do, that's another topic. We won't even get into that. But under the income-based repayment plan for regular folk, you, who I'm talking to, more than likely, after the 20-year plan of paying consecutive for 20 years, your debt is discharged. Well, we just said that there's really nothing that you can get, something that you can get for nothing. So if you get that debt discharged, what happens is the amount that's discharged, you're now taxed on. So I know you didn't think Uncle Sam was going to let you off the hook like that. He's going to say, thank you very much, Dr. Smith, for making that payment. You made it on time. We appreciate it. Now remember, they've lowered the payment to make it more affordable for you. Your interest payments are continuing to grow. Your balance is continuing to go up. I don't know if many of you saw me on the news, but when I was interviewed there, I was talking about a client that I had who, when she came to me, she couldn't understand why her student loan balance was going up. She's like, I've been paying this payment for 2 years. I'm in the income-based repayment plan and it keeps going up, and I'm making my payment on time. So when we got in and we looked at it, they had her on a plan of about $900 a month is what she was under the income-based repayment plan making, and she should have been what we found at, I believe, $1,400, what the payment should have been. So that's why your balance is going up. So it only makes sense if you're not covering enough of the interest to include the principal and interest, then your payment is going to continue to go up. Your balance is going to continue to go up. So at the end of the time, let's look at our example again. $200,000 student loan at a 7% interest rate. Well, on the income-based repayment plan, we're $895 a month, remember? If we pay that for the 20 years on time, what we're going to have is now a balance of $368,065 is what we paid back over that 20-year period. So we started at $200,000. We're left at $368,065 is how much we pay, with interest into that. So at the end of that time period, we have $83,506 that needs to be forgiven. I'm sorry, not forgiven, because remember, forgiven is when you forgive somebody. If you really forgive and forget, you never bring it up, never think about it again. So those in public service that pay for 10 years can have their loans forgiven. Those who are having their loans discharged, if you pay for 20 years. So you're going to get that tax bill, and that $83,000 in this example, the $83,506 is going to be added to your income. So let's say you make $110,000 a year in your profession. That year, you're going to add that $83,506 to it. And now it looks like you make almost $200,000. There's a big difference in a tax bracket increase from what you would be paying at $100,000 versus almost $200,000. So all that glitters is not gold. I just want people to be very clear about that. You're picking the lowest payment, you're excited, you're waiting for the 20-year payoff. And more than likely, in most cases, what I've seen with the clients that come to us, it's a setup, and you're going to be in for a rude awakening. Another thing that I want to point out that's really important to stay on top of, I actually had a client come to me in this predicament. You have to, with these payment plans, income-based repayment, play as you earn, whatever plans they have out there, you have to qualify annually. So it's income-based. It's based off of your income. Most people get raises every year, new positions, you make more money. They want to see that. They're in your pockets and in your business monitoring what do you have going on. So it's your responsibility as you're approaching the end of your year, if you enroll in one of these programs, in this specific program that I'm talking about right now, the income-based repayment plan, that you contact the lender to review the paperwork. And you have to resubmit, fill out an application, look at your W-2s, pay stubs all over again, so that they can adjust the payment if need be. So what happened with a client who came to me is she didn't do that. She just completely forgot. The lender is under no obligation to remind you and say, hey, Dr. Smith, you're approaching that year mark. We need to get your paperwork. They're actually hoping that you don't remember so that they can do what they did to my client. And what they did to her was she made her normal payment, and then because she did not review and reapply, they hit her for what her payment would have been under the standard payment. And as we saw here, it's almost 3 times more. So when she called, they're like, oh, we're sorry. Of course they didn't send her a check back or give her, a refund on the amount. They kept it. So it's really important to stay on top of the program, know what's going on with it, know how it's going to affect you. What else do I want to say about it? I think that's about it. Really, just key, the canceled amount that you get discharged, not forgiven, is going to become taxable income. So what I like you to do, if you are in one of these repayment plans for your student loans and you want to know where you are and where you will be at the end of that 20-year term, hypothetically, because as we say, your income may adjust, but if you continue to pay on the lowest payment that you can possibly get, then it's pretty much, I can tell you what you're going to be looking at, the amount that be forgiven at that time when you get ready to have your loans discharged at that 20-year time period that everybody's excited about. So just wanted to give you that. Hopefully you learned a little bit about, something that you didn't know with the income-based repayment. Again, if you are in the income-based repayment plan and you want to know where you are versus where you will be, what you're paying now versus what you will have, your balance will be at the end of that 20-year period, contact me, send me an email, send it to the office. You can go on the website, yourmoneymd.com. You can send us an email at accounts, ACCOUNTS, at yourmoneymd.com. Just send over a scenario just to see where you are and where you'll be, and we'll take a look at that for you, included in a free consultation, just to let you know and give you some more information on where you are. So really think about, what you're doing. Try to get all the facts, read the fine print. They don't point that out to you. They harp on, we're going to forgive it after 20 years. You just make your payment on time. Yeah, okay. They will, but again, Uncle Sam will have his hand out. So that's it. Hope you learned something in the income-based repayment plan that you didn't know. If you have any questions, again, comment. Any topics you'd like us to discuss, to cover, educate you on, let us know. Shoot us an email. Follow us. Subscribe. What else can you do? I don't know. Fax us. Get in touch with us. As always, thank you tuning in. Want to make sure that you're financially free with MoneyMD.